Now, moving on from the assets into a new category, we also have a category of liability accounts. Now, these are different than assets. Remember, we said before that liabilities are actually debts. So these actually represent obligations. There are 4 of these that we're going to talk about. The first liability is called accounts payable. Now, you'll recall that earlier we had an asset called accounts receivable. Well, this is the opposite. Accounts payable means that we owe money. So our business owes money. So that's actually a liability. And it's a liability because down the road we're going to have to settle that by actually sacrificing some of our cash. So anytime we purchase something and we charge that, it is considered to be a liability, and it is considered to be an account payable. Typically, we abbreviate accounts payable as AP or A/P. The next liability would be note payable. And just like we talked about before with accounts receivable and note receivable, the same differences apply to accounts payable and note payable. A note payable means that we do owe money, but the difference is it is a written agreement and we're being charged interest. So if those 2 conditions apply, then it is considered to be a note payable rather than an account payable. And again, we would abbreviate that as N/P. And one thing that I've noticed is that initially, when most people start out with accounting, they do have a tendency to get accounts receivable, note receivable, accounts payable, and note payable confused because they do sound very similar. But the more you work with these things and the more you practice with them, you'll be able to differentiate and to distinguish the differences. And then we have unearned revenue. And unearned revenue, this is also considered to be a liability. With unearned revenue, anytime someone pays us in advance, well, we haven't earned that revenue. And you'll recall from an earlier video, we said that there is a revenue recognition principle. And it does say that until we've earned the revenue, we're not allowed to recognize it. So whenever someone pays us in advance, we have to record that as unearned revenue. And this is a liability. Now, we're not ever going to have to pay for this, but we do owe something. And what we owe is a service or a product or whatever it is that they paid us to do. So until we do those things to settle that obligation, this is considered to be a liability. Then we have the equity accounts. And there are 4 different components of equity. It's going to be pretty easy for you to remember these because these 4 components of equity are the same exact components that we talked about in a previous video. The first component is the capital. But notice that we've said owners, capital. And generally what we would do is put the name of the owner in front of the capital account. And that owner is, of course, the sole proprietor if you're dealing with a proprietorship. So it could be John Doe Capital, whatever the name of the person is, but that name is always in front of the capital account. And as we said before, this represents investment in the business. Anything that the owner contributes is always going to go under capital, and it's always going to have a positive effect. And then at the same time, we also have that second equity component, the owner's withdrawals. And again, anytime someone removes money from the business or removes assets, that's a withdrawal. So that's where we would record that. And again, we would put the name of the owner in front of the account. And if it's a proprietorship, we would only have one owner. But if it was, say, a partnership, for example, you would actually have separate accounts set up for every owner. Then you have that third equity component, which would be revenues. And like we said before, this is where we make our money. And it might be a product that we sell, it might be a service, or it might be a combination of things. There are some companies that actually have multiple sources of revenue. And if we do have multiple sources, then we can actually take the revenue account and set up a separate revenue account for every type. So for example, consulting revenue, rent revenue, repair fees earned, any type of work that we do, we can set up a different account to track that revenue to see where it's coming from. And then the fourth component would be the expenses. And this represents an outflow of money. It represents a negative effect. And of course, we're going to have lots of different expenses. We're going to have to pay utilities, salaries, advertising, insurance, taxes, many different things will have to be paid for. And we can set up a separate expense account for each one of these items. Now, going back to the accounting equation, we've talked about it before. And remember, we said that the accounting equation must always be in balance. If that balance isn't true, then we definitely know that there's something wrong with the way we've done the accounting. It always has to be in balance. But now that we've talked about the different accounts, we now see a slightly different version of the accounting equation. Previously, we said it was assets equal liabilities plus equity. But if you think about it in terms of this version, it's all the asset accounts. So it's the cash, the receivables, the land, the buildings, all the assets that we own, all those accounts totaled together equal to all the liabilities totaled together and all the equity totaled together. So that is a relationship that you always expect to see balanced out and equal no matter what company that you're dealing with. And then ultimately, like I said, with chart of accounts, it is simply a listing of all the accounts that that company uses. And it's very useful because when I look at that chart of accounts, it tells me what I have to work with, and it also tells me a lot about the company itself. And it's going to list every single account that they maintain, so that way I know what they're going to use and what they're not going to use. And also, like we said before, there are no two chart of accounts that will necessarily be the same because no two businesses are necessarily the same. So the chart of accounts is customized to every business so that you can see the accounts that they need. For example, land is an asset, but if you have a company that doesn't own any land, there's no sense in them having a land account. So they only have the accounts for the things that they need to utilize. And if I look at that chart of accounts, it will tell me so much about the type of business that they are, what they have to work with, and it will give me the definitive list of all the accounts that I have to utilize when I do my accounting recording.